Hi everybody, Alex Apple here from Expert Forex, and in this video we're going to be looking at learning how the market wants to be traded. And I often quote to my students that the market tells you how it wants to be traded, and they look at me as if I'm completely mad. But in this video we're going to explore what I mean by listen to what the market is telling you, and it will tell you how it wants to be traded. So as the slide says, rather than fighting the market and getting frustrated at the inconsistent results that you're getting and the inconsistency of the market, rather make friends with the market and listen. One of the biggest mistakes I see Forex traders make is they take a particular trading technique and they try and force it onto the market, and by doing that, they're saying, hey, market, I am the boss. This is my technique. I know this one will work. And the trader is forcing their ego onto the market. And then the trader will get very upset when trades go negative. Now, that whole process discourages the activity of listening to the market to hear the way it wants to be traded. If your ego's too big, you're not going to be able to listen to the market. So let's have a look at ways of listening to the market. Firstly, by analyzing your winners and your losers, the market is telling you, hey, you made a mistake here, you should have traded me in a different way, or great, you traded me in the correct way, and you were awarded for it. Then the other way of listening to the market is just plainly looking at charts with an open mind, and I'll give you a lot of examples of all of this. The next one is to backtest your technique on the market and listen to the changes that the market is suggesting. And there is a checklist which you can use for doing that. And then you can always forward test your techniques into the market. But the best one is to create a really healthy relationship with the market. So let's look at these points in a little bit more detail. Now, the first point is analyze your winners and your losers. Now, I can't tell you, and I haven't got the statistics, but I have a good idea that 90% of Forex traders do not analyze their winners and their losers. And this does not only apply to manual trading, it also applies to EA trading. You have to look at where you're losing and where you're winning, and why you're winning in certain cases and why you're losing in certain cases. So let's have a look at a checklist that you can use for this kind of thing. So, and maybe I'll go through each particular one. Were my entries too early or too late? Very common reason for failure or success. Were my stops too big or too small? Were my targets too big or too small? Was my lot sizing too big or too small? Was my direction wrong? Did my transaction lack volatility? In other words, you got the direction right, it ran all of 15 pips and then just sat there and did nothing. Did you enter at the wrong time of day? I see a lot of people getting perfect setups in the Asian market. The Asian market has no volatility, and it will not give you the same results as trading in the UK or the US markets. What changes will improve my results? So you need to look at any of those points that I've mentioned already so far. Were the market conditions appropriate to my technique? It's useless trading a bounce technique in a trending market, or that kind of thing, or an extremely consolidating market also is a dangerous one to trade inappropriate techniques in. Would my results have been better if I used a different technique? So you look at the trade that you've had, let's say it's a losing trade, then you say, all right, well, if I used this technique or that technique, I would have had a winner. Did I miss seeing important support and resistance? A very common problem with especially not the placing of the entry, but the placing of the stops and the targets. Sometimes that can restrict your profitability on trading. Should I have traded a different currency? Very often, a very common mistake where the same setups may occur on the pound USD or the Euro USD or the Oz USD. The same setup occurs, And people trade the least volatile of the three instead of trading the most volatile of the three. So that's a very relevant question. Did I ignore the relative or dominant strength of currencies? When the USD is dominant, it can create tremendous trends for all its crosses. Now, the same thing applies to the yen. You need to watch the yen. When that one is dominant, it will pull all its crosses with it. So you need to watch the relative strength of currencies. Was I too emotional during the trade? In other words, did you let the emotions get? Did you move your stops in the wrong way, or did you move your targets, or did you put in a following stop that was too tight? Did your emotions get the better of you? And was the trade overmanaged? Again, a very, very important reason for underachievement in this market is that people try and overmanage. They try and get it a trailing stop that's too tight, or they overthink the transaction. A transaction needs room to maneuver and move, and transactions are very often overmanaged. Did I protect my gains enough? I often see people going plus 50 pips on a transaction and it reversing and hitting their stop. So they go from plus 50 pips to maybe minus 60 pips, and that's just unacceptable. You know, there is a point at which you need to protect your gains. And then there are many other items that I could add to this checklist, but I've just really mentioned the main ones. So what you would do is every trade, and you would do this for EA transactions and manual transactions, you would go through this checklist and analyze your losses and even your successful trades using this kind of approach. Now, I can tell you now, very few people do that. They are so disappointed by a losing trade that they just want to move. They don't want anything to do with that trade anymore. And that is where the biggest mistake is. Those are gold. If you analyze those losing trades, I can guarantee you within a month your trading will turn around and be totally different. Okay, so then the next one is just look at the charts with an open mind. Open and a relaxed mind. Just don't overcomplicate, don't overanalyze. Just look at the charts and say, you know, maybe I would have caught this deal if I used this technique or that technique. And here we have a very simple technique, which is a trend line violation. So this trader would have caught a very nice move there with a trend line violation. There's a trend line violation. There's a trend line violation. There's a trend line violation, and so on, all trend line violations. If you do an exercise just trading trend line violations, which is the simplest and most uncomplicated way of trading, you will be amazed at the deals that you catch because of trend line violations. Now, this is just one example. You could even use moving averages. You could use anything like that. Look at the charts and say, gee, how can I take advantage of this price action that's happening in front of me? And you play around, you experiment with things with an open mind, a relaxed mind. Very important to be relaxed. Don't be tense, because your imagination, creativity will be badly affected by that. And just look at the charts and say, hey, hang on, you know, let's forget about everything I ever knew about Forex trading. Let's just look at how the market is asking me to trade it. And this is what I've done on this particular chart for it as an example. So let's move on. Then the other thing you can do is backtest your techniques, and you then backtest them using that checklist that I've just done. So you can backtest in numerous ways, and let's have a look at some of the ways. There's something called a Forex tester, where you can go back into history and trade the market as if it's a live market, and you can therefore get the experience of making decisions on the move. You know, you can see, oh, this setup's fantastic. I'm going to enter a sell. You actually physically enter the sell, and you put your stop and your target where it should be, and that kind of thing. So it's a very fantastic software. I see there's a fantastic special on at the moment. I am a partner with this company, so if you use this link, you will get preferential pricing. So this is one thing to consider. The other one is to just plainly use MT4 for backtesting. I have created a video that shows you 3 ways that you can backtest using MT4 to perfect your losing or winning techniques. And a link to this will be shown right now on the top right hand side of your screen to go to this particular video. So backtesting is most probably the most important thing to do. Now, to give you an example of an EA backtesting process, I'm going to look at the double in a day EA. Now, the double in a day is not a continuously traded EA. But by back trading, you can find reasons why double in a day transactions occur. So what I've done is I've created a test only for a month because I just want to show you the principle for the double in a day EA using the euro yen for the month of February. And as you can see, this is an equity graph. We started with 5,000. We were lucky to have a double in a day trade straight away. But then it goes into a loss period like that. And then it has a double in a day trade and goes into a loss period, the double in a day trade and a loss period. So why would one back trade an EA that is not meant to be continuously traded? The whole idea is, and the traders that do exceptionally well with the double in a day trading, is what they've done is they back trade the double in a day on a continuous basis, not so much to see the losing phases, but to see under what conditions the entries into double in a day trade took place. That way the market is telling them, if you want a fast move in the market that has the potential of a double in a day trade, then you need to enter where these past double in a day successful trades have occurred. And they don't only analyze 3, as we've seen, as you see on your screen here, they analyze hundreds. And after analyzing hundreds of trades, they can determine where the highest probability of double in a day trades occur. And what's nice about a double in a day trade is, in this example, we're risking 5% to make 100%. So when you have a successful trade, you are doubling the risk amount that you're working with. And then obviously you lose. But you can see you can lose more than 20 times to even just break even. So in this case, the losses were most probably 15 times. Then we had a successful trade, and then the losses were most probably again 15 times, and then we had a successful trade, and then we had a whole lot of losses again, and hopefully there'll be another successful trade that boosts this one. But that's how double in a day trading happens. You do have a lot of failures, but when you have a success, it's a huge big jump. So again, just coming back to the reason for back trading is not to actually get the profitability over that period, although this period was nicely positive. It's really for traders to have a look at when double in a day trades occur and what kind of signals they can identify to do that. And to do that, what they do is, firstly, let me just show you that was nicely positive over the period, very small drawdown, but we were lucky because there was a double in a day trade right in the beginning of this one. But what the traders would do, firstly, they'd identify the winning phases. So the orange that you see here are the winning trades. So it goes from there up to there, and from there up to there, and from there up to there. But it also identifies the losing phases. So there are the losing trades, and the losing trades are all over there. So the trader can then say, all right, what can I do to change this profile? How can I not have such big losses in the losing phases? And what can I learn from the entries that have resulted in these double in a day trades? Where have they occurred? How could I have possibly got into that trade? How could I possibly have got into that trade? And how could I possibly have got into those trades? All of them seem to be channel trading related, but that's the purpose of this back trading, is to actually educate yourself and listen to the market, and the market is saying, if you want to catch double intraday trades, here is how you do it. So this back trading is really ideal for finding entries. Now, if you've got about 100 entries and you can identify the reasons for those particular entries, you have a big chance of creating a nice short list of potential areas where you can enter double in a day trades. Remember, double in a day trading is meant to only be entered when there's a setup that occurs that is a high probability setup as identified by the trader in his back trading experience. Then the next item on the list is forward testing your techniques. Now, I must stress, forward testing your technique is the worst thing to do on its own. You have to backtest and backtest and backtest thoroughly, and then only do you cannot forward test without backtesting. I see so many people buying something or doing a course and then just forward testing that course. You cannot do that. You must backtest, because backtesting will give you the knowledge that this doesn't work in this kind of market, or you need this kind of stop and this kind of target. Backtesting supplies you with all that information, and that's how the market talks to you. So the steps are backtest, backtest, backtest until you're confident about the technique, then you forward test. You don't start forward testing. That's another major mistake that Forex traders make. You learn absolutely nothing from forward testing your technique. And then the fifth point is create a relationship with the market. And by that, I mean really know what's going on in the market, know how the Forex market works. And I'm talking almost about an intimate relationship with the market. You must know the market's mood. Is the market uncertain, or is the market very certain, in which case it will be trending? Is the market just dawdling around? That kind of thing. You must be sensitive to that. You need to see the phase of the market to really know when to trade and when not to trade. Again, the market's phases are important, and again, this is more specific. Is the trending? Is it going sideways? Is it consolidating? Is it moving in a wavy way? Is it channeling? Is it doing those kind of things? So you need to know the market phases, and then you need to know the nature of the market. You need to know everything about the market. Which currencies are really bad to trade? Which currencies are good to trade? Which time frames are better than other ones? And you only get that, and I'm coming back to that point, you only get that through thorough backtesting. You cannot ask a guru which is the best time frame to trade, or which is the best currency to trade. You should not do that. You should create that knowledge for yourself. I always say you cannot pay somebody else to do your push-ups. So you need to do your own push-ups. You need to go and backtrade and backtrade and backtrade and create your own favorites for your own reasons when you trade. So just in summary, every activity in the market is a learning experience where the market is telling you, is talking to you and telling you, hey, you're not trading me properly, and you need to listen to that information. The more intimate you are with the market and with your trading techniques, the more successful you become. It's just a self-fulfilling prophecy. And the best way to learn is through extremely high activity. Backtest over weekends, backtest in the evenings, backtest, trade as many, trade 10 demo accounts at the same time. Your activity level is directly proportional to your success rate. Because why? If you apply what I've said in this video by analyzing your successes, analyzing your failures, you will create that intimate knowledge with the market, and the market will tell you how it wants to be traded. You just have to be open to that. And again, I must remind you that everything I'm saying here applies to manual trading as well as EA trading. EA trading can be backtested in a visual mode, and as you've seen earlier, I've given you an example of backtesting in a slightly different way, but there are various ways you can backtest EAs to make sure that you understand and that you have an intimate knowledge of how it relates to the market. And then the last point, which is very sort of interwoven into everything that I've said so far, is your actual and back-traded results represents the market talking to you. So all you have to do is listen very carefully. I hope I've given you some ideas on how you can learn in which ways the market wants to be traded and that you can make use of that information. From me, Alex Deploy, cheerio.